Welcome to Stock Mo. You know that feeling when you think you're doing everything right. You're reading the news, you're watching the market, you're being patient, and then you open your brokerage app one morning and your stomach just drops. That feeling is exactly what we're unpacking today. 'Cause I'm going to walk you through a real portfolio, not a simulated one, not back-tested with perfect hindsight, a real live skin in the game portfolio worth over $200,000 with real losses, real gains, and real reasons to stay invested anyway. And by the time we're done, you might completely rethink how you're building your own positions right now. Before we go any further, if you're serious about understanding the market, not just chasing headlines, but actually thinking like a long-term investor, you belong here at StockMo. Hit subscribe right now. We put out content every week for people who want to grow real wealth, not just watch numbers bounce around. Subscribe and let's get into this. This portfolio holds 8 stocks. 8. No spreading capital across 40 positions just to feel safe. This is concentrated conviction-based investing, and it demands a very specific mindset. Some months you open your account and it genuinely hurts, but when you're right, you're really right. Despite some painful open positions, the track record here shows over $90,000 in realized profits across 11 closed trades. Every single one of them positive. That's not accident. That's a system worth understanding. I want to be upfront before we go stock by stock. Nothing here is financial advice. I don't know your age, your situation, or your goals. What I'm doing is walking you through a real investor's honest thinking on each position. The thesis, the concerns, the self-assessment. You take that and do your own work. That's how serious investors operate. Let's start with the smallest position in the portfolio. Booking Holdings sits at about 5.5% of total assets. The original thesis was straightforward. Travel is a secular growth story. As global populations grow and parts of the world that weren't participating in the travel economy start entering it, particularly across Asia as the middle class expands, platforms like Booking.com are positioned to capture that demand over a long horizon. Revenue and profits are both growing around 10% annually. The business is actually cheaper today than when the position was first opened because the stock has drifted lower while the fundamentals have held up. But the reason conviction here is moderate rather than high comes down to external uncertainty. Geopolitical tensions affect travel sentiment in unpredictable ways. And a bigger question hangs over the industry. What does AI do to how people discover and book travel over the next decade? Nobody has a clean answer to that. For someone with a long time horizon who wants exposure to global travel trends through a business they can actually understand, this is worth watching. But it's not the position anyone would be pounding the table on right now. Moving up in size, the next holding is a micro-cap medical device company sitting at around 7.5% of the portfolio and currently down about 21%. This one is not for the faint of heart. Microcaps operate in their own category. A company at a $170 million market cap that finds its footing can multiply several times. But the path is almost never smooth. This position rose nearly 25% after entry and reversed hard after one segment of the business failed. Roughly $30 million essentially lost and the CEO resigned. Executive departures at small companies are uniquely destructive. A large corporation has institutional layers that carry it through a leadership change. A microcap loses its CEO and the market questions everything at once. Stocks in that situation typically take 6 to 12 months. Stabilize even when the underlying business is sound. The reason for holding is that the most recent quarterly results were genuinely strong. Revenue growth has returned. The valuation looks low by almost any reasonable measure. If you can hold through volatility without losing sleep, beaten down small companies turning a corner can deliver outsized returns. If you need stability in your portfolio, this category of stock is simply not suited for you. Knowing yourself is as important as knowing the company. Next is Microsoft at about 8% of the portfolio, a more recent position that's already slightly positive. I want to say something here that gets lost in a lot of investing commentary. Not every position has to be your most exciting idea. Sometimes you see a genuine disconnect between where a company's stock is trading and where its fundamentals are heading. And that alone justifies owning it. Microsoft is in exactly that situation right now. The share price has been drifting lower while revenue and income continue climbing. That kind of divergence is rare for a company of this quality. The last time it appeared in any meaningful way was in 2022. And investors who recognized it then did very well over the following 2 years. Azure is growing. AI infrastructure spending is benefiting Microsoft's cloud division directly. The balance sheet is clean. This isn't the most thrilling pitch in the world, but recognizing quality on sale and having the patience to let the market come around to your view is often where the best long-term returns are actually made. There's also a cash position of about 9% that came from closing a health insurance company bought purely on valuation when sentiment was extremely negative. The exit was made not because the thesis was wrong, a solid profit was captured, but because the investor honestly acknowledged it was outside their real area of competence. The U.S. health insurance market involves regulatory complexity and actuarial dynamics that are genuinely difficult to model without deep industry knowledge. Knowing what you don't know is a real edge in this game, and not every investor takes it seriously enough. If this kind of no-filter breakdown is what you've been looking for, drop a comment below. Tell me which stock you're most curious about. And share this with one person in your life who's building real wealth. It genuinely helps us reach more people who are ready to think seriously about their money. Now, let's talk Novo Nordisk, sitting at roughly 9.5% of the portfolio and hovering near break-even. Novo makes some of the most widely discussed drugs and medicine right now, GLP-1 medications for weight loss and diabetes treatment. The position was opened after the stock fell sharply when U.S. government price caps on certain GLP-1 drugs compressed revenue expectations. Since then, one of the newly launched products has seen some of the strongest patient adoption numbers in recent pharmaceutical history. The science appears to differentiate meaningfully from competing treatments. And yet, the stock has continued to struggle because the market is carefully weighing near-term pricing headwinds against long-term potential. The fundamentals present an interesting picture. Net income has continued to grow even as the share price has declined, creating a widening gap. Historically, that kind of gap eventually closes, usually through price recovery. A fair value estimate based on revised expectations puts the stock meaningfully above where it currently trades. The conviction to hold is there, but the enthusiasm is measured. There are compelling opportunities across many areas of the market right now, and this is not the highest conviction position in the book. Now, we get to one of the genuinely painful ones, a major digital payments company at nearly 11% of the portfolio, down about 21% and representing roughly $6,000 in unrealized losses. The entry was based on a technical read that a key support level would hold. It didn't. The stock broke lower, and a CEO resignation shortly after added real uncertainty to an already complicated story. The honest assessment here is conflicted. On valuation alone, this looks inexpensive. The market is pricing it like a business in permanent decline, and by earnings and cash flow measures, it does appear cheap. But structural headwinds are real. Competition in digital payments has intensified enormously. Newer platforms are capturing consumer and merchant attention at a faster pace. The question isn't whether the business is cheap, it is, but whether cheap is enough when growth isn't compelling and the competitive moat is narrowing over time. There's a reasonable case that patient investors who buy at today's prices won't lose money over 3 to 5 years. The business generates real cash and still serves hundreds of millions of users. But there's also a legitimate case that this is a value trap, cheap because it deserves to be with no clear catalyst to change the narrative. No final decision has been made, but the discomfort around this position is itself informative. When you're not sure whether you want to own something, that uncertainty deserves serious honest attention before you do anything. Moving to Adobe, about 11.5% of the portfolio and down around 13%. The bear case on Adobe is entirely narrative-driven. AI will transform creative work. New tools are constantly emerging that can generate images, edit video, design layouts. Why pay Adobe subscription prices when AI can produce results for free? That story has crushed the stock, pushing it from well above $500 to the mid-200s with sentiment about as biology and lifestyle rather than generalized protocols, is a direction that virtually every credible healthcare analyst agrees will be significantly larger in the future than it is today. And peptide therapies, customized biological compounds targeting specific functions, are emerging as a meaningful frontier in that space. This company is positioning itself as the consumer-facing platform for exactly these kinds of treatments. It has a growing subscriber base, brand recognition in a space where most competitors feel clinical and impersonal, and is building the infrastructure to deliver increasingly sophisticated care at scale. The stock has been volatile, and near-term numbers are messy. But for investors willing to look past that, the potential over a multi-year horizon is real. Particularly if personalized medicine continues its transition from niche to mainstream care delivery. And now the position that commands the most attention, 25% of the total, $60,000, in a leading language learning platform. If you haven't used Duolingo recently, open the App Store right now and spend 10 minutes with it. You'll start to understand why someone would put a quarter of their investable assets into this company. The product is genuinely engaging in a way that delivers real educational value while keeping users returning day after day. The gamification is sophisticated, the pedagogy is sound, and the engagement metrics, daily active users, retention rates, subscription conversion, are the kind of numbers that consumer technology investors look for in a category leader. Here's the bigger picture. We are at the very beginning of AI's transformation of education. Language learning is what this platform does today, but the underlying engine, personalized adaptive instruction that adjusts in real time to what a learner knows and doesn't know, is applicable to every subject. Mathematics, science, professional skills, test preparation. The platform is built for massive scale. And the learning data accumulated from hundreds of millions of users is an asset that a new entrant could not realistically replicate. The CEO is among the more impressive executives in consumer technology today. Communication with investors is transparent. The product roadmap is clearly connected to a long-term vision that goes well beyond language learning. The business is growing fast enough to justify a premium valuation for investors who can think 3 to 5 years out rather than 3 to 5 quarters. The position is down about 12% from its average entry price. The response to that? Buy more if it drops further. That's what genuine conviction actually looks like. Not just holding through pain, but viewing lower prices as better opportunities rather than evidence you were wrong. Let me pull back now and share a few things that cut across all of these positions because they're more valuable than any individual stock name. Knowing your circle of competence is one of the most important edges an individual investor can have. The one position that was closed at a profit, the health insurer, was sold specifically because the investor acknowledged they couldn't confidently model the risks involved. That honest self-assessment protects you from the losses that come from investing in businesses you don't truly understand. CEO transitions create temporary uncertainty that often depresses stocks below fair value. Multiple positions here saw executive departures after purchase. In every case, the stock sold off. In every case, the key question is whether the business is strong enough to absorb the change and come out the other side intact. For large entrenched companies, the answer is usually yes. For smaller ones, it requires much more careful and ongoing analysis. And the most important point of all, being down on paper is not the same as being wrong. A stock can be lower than where you bought it and still be an excellent investment. What matters is whether the thesis that drove your purchase is still valid. If it is, lower prices are opportunities, not warnings. If something fundamental has changed, cutting the loss and redeploying capital elsewhere is his right move. The hardest discipline in investing is separating those two scenarios with clarity and honesty without letting emotions drive the decision. Before I let you go, if this gave you something real to think about, hit the like button. Share it with someone navigating their own portfolio decisions. Leave a comment, a question, a pushback, your own take on any of these positions. The conversation in the comments here is genuinely one of the best things about this community. At Stock Radar, we believe the investors who do best over the long run aren't the ones chasing hot names or reacting to every headline. They're the ones who build real understanding of what they own, who have the patience to hold through discomfort, and who are honest enough with themselves to know when they're wrong. That's what we're here to build together. The market is full of noise. Your job is to find the signal. See you next week.